The fourth quarter of 2022 is set up to be a wild ride for oil markets, and all that starts this Wednesday when OPEC gets together in Austria. And you need to stay till the end because there's one little thing that could happen on Wednesday on top of the production cut that could make the move in oil even more severe. What's up, guys? I'm Nobody Special, and since the middle of June, oil prices have been on a steady grind lower from their highs of around $120 a barrel all the way down into the mid-70s. Now, I've been hesitant to call a bottom in oil markets for a while now because the charts just weren't showing it to me. But last Friday, I finally caved in and I called the bottom in oil because I saw a couple of things that are lining up, and every single one of them is set to put upward pressure on the price of oil. And with that, we are going to shrink my big melon of a head, and here you go. This is the price of oil going all the way back about a year. And you can see oil prices started the year with that rip-roaring rally in the build-up to the Russian invasion of Ukraine. We had that big spike up to about $130 a barrel. We finally settled down. We ended up peaking in mid-June around $122 a barrel. And that's when the dumping of the Strategic Petroleum Reserve hit its stride, and prices have been declining ever since. We bottomed just a few days ago around $76 a barrel, and we've caught a little bit of a bounce since then. And I think that bounce is going to hold because this Wednesday OPEC gets together. And there's already whispers of some big news coming out of Vienna this Wednesday. This is in the Detroit News dated last night. Oil jumps as OPEC mulls its biggest production cut since the pandemic. Oil surged to $82 a barrel on indications that OPEC Plus alliance is considering cutting production by more than 1 million barrels a day to revive plunging prices when it meets this week. Now, I talked about this late last week in my live stream, and in all the articles I saw last week, the discussion centered around production cuts up to 1 million barrels a day, and yet this morning they're talking about production cuts by more than 1 million barrels a day. So a very slight tweaking of the language, but still in a tighter direction. A reduction of that magnitude would be the biggest since the pandemic, although OPEC Plus delegates said a final decision on the size of the cuts won't be made until ministers gather in Vienna on Wednesday. West Texas Intermediate futures jumped around 3%, on track for the first gain in 3 sessions. Now, one important thing to keep in mind here is that OPEC actually needs to cut their production quota right now. It's not so much about lower prices, although that is a factor. OPEC wants prices higher, but OPEC needs to cut their production target just to maintain any credibility, because for the last couple of months, OPEC has been continually increasing their production targets, and yet their production, the actual oil they've been pumping, hasn't kept pace with those increases. And the gap between their production quota and their actual production has continued to grow as these quotas rose. And you can see that here in this chart. Look at this growing gap. The red line is OPEC's production quota, and the blue line is their actual production. And even though that quota continues to rise, they have not hit it once since the start of the pandemic. And then all of a sudden this year, we've actually had a blowout in the gap between the quota and the actual production, because we've had a lot of things like social unrest in a lot of countries around the world because of the spiraling cost of living and the inflation, something we predicted here on this channel. And we've also had the sanctions taking their toll on Russia's oil production as it gets harder and harder for them to maintain their sales as they've been cut off from the banking system. That's affecting everything from payments to the purchase of spare parts and labor, and it's resulting in lower production. So as of right now, the gap between the quota and the actual production has grown as high as 3.5 million barrels per day. So OPEC needs to cut this quota, not because they need to jawbone prices higher, but because nobody's going to care about their quotas if they continue to miss them by such a huge margin. So this 1 million barrel per day cut to the quota that they're predicting, it probably won't even be the last cut that they make, because they need to cut by as much as 3.5 million barrels just to come in line with what the actual production is. So there is an element of face saving by OPEC here, as well as their need to drive prices higher. Now, another thing you need to consider is the strength of the US dollar, something we've been talking about on this channel a lot. The US dollar has been on an absolute tear since the start of this year, increasing in value relative to other global currencies. The pound, the euro, and the Japanese yen have all depreciated against the dollar. Well, you have to keep in mind, most global trade is still done in US dollars. And so if the dollar gets stronger, that means the dollar price of the oil goes down. So the strong dollar has been a headwind for oil prices all year. That's changing, at least in the short term. And you can see that on this chart. This is the DXY, sometimes referred to as the Dixie or the US dollar index. This measures the strength of the US dollar against the euro, against the yen, against the pound, the Swiss franc, the Canadian loonie, a whole basket of other currencies. and the dollar has been on this upward trajectory all year long. And you can kind of see this line I put in here connecting the lows. And just a few days ago, the dollar moved to such a ridiculous high that it was long overdue for a correction or a pullback towards the lower end of this trend that it's been in. Even though all the conditions that are driving the dollar higher are still present, the technicals have said the dollar has run too far too fast. It needs to correct, catch its breath before resuming upward. So that means in the short term, there's going to be some upward pressure on oil prices caused by this technical correction in the US dollar. Something that started a few days ago when the Dixie peaked over 115. It's now sitting just under 112. I think it's probably heading lower, somewhere around 110, 109 at least over the next week or so. That's going to put upward pressure on oil prices also. Now, besides the strong dollar, one thing that's been really putting downward pressure on the price of oil for the last couple of months has been the dumping of U.S. oil from the Strategic Petroleum Reserve. The Strategic Petroleum Reserve, or the SPR, are these giant underground salt caverns that are full of oil. That's the U.S. government's savings account of oil. It's something we started in the late 1970s in response to the OPEC oil embargo against the U.S., something that was crippling to the U.S. economy, and it contributed to the high inflation of the 1970s. So we created this big reserve of oil to insulate ourselves against higher prices. Well, starting in May, the Biden administration started dumping up to 1 million barrels a day from the Strategic Petroleum Reserve. Biden has dumped more oil from the SPR than every other president combined since the SPR was created, something he's caught a lot of flack for because he's placing politics over the national security of the country. And here we are in just the news. Biden is dangerously draining the Strategic Petroleum Reserve like a campaign credit card, the industry warns, with crude inventory in the SPR down to its lowest level since Ronald Reagan's first term. President of the U.S. Oil and Gas Association, Tim Stewart, said the reserve is being used by Biden to buy down political risk ahead of the midterm elections. Well, those midterm elections are just over a month from now, and those releases from the Strategic Petroleum Reserve are going to end right after the midterms. Conveniently timed, isn't it? So when the dumping of the SPR stops, that's 1 million barrels a day of oil supply that's going to dry up instantly. That's more oil per day than most medium-sized OPEC countries are able to produce. So that's going to put more upward pressure on oil prices. Another factor that's going to put upward pressure on oil prices is a phenomenon called fuel switching. It's no secret that Europe is in an energy crisis right now, and the price of natural gas on that continent has exploded to ungodly highs, and the entire continent is facing bankruptcy as a result of it. That's driving a lot of people in Europe and elsewhere in the world to switch from natural gas to things like fuel oil and diesel to try to save money. That means more oil demand. And here we are in S&P Global. This is dated September 7th. Global gas to oil fuel switching to jump 80% as European and Asian gas prices soar, switching to account for 633,000 barrels per day of demand growth in the first quarter of 2023. European gas and Asian LNG is 6 times more costly than fuel oil on an energy basis. European refiners are heavily exposed to Russian-Ukraine war gas price hikes. So right there, 633,000 more barrels per day of oil demand on top of 1 million barrels per day less supply because of the SPR dumping ending and another 1 million barrels per day of less supply from the OPEC production cuts. That means a net 2.6 million barrels per day of additional tightness in oil markets. You better believe that's enough to send oil prices back over $100 real fast. Now, these are all things that are supposed to happen in the very near future, but there's a couple of other scenarios that could play out that could be even more catastrophic for oil prices. Consider the situation in geopolitics. Somebody, probably us, just blew up the Nord Stream 1 and 2 pipelines, and this happened hundreds of miles from any battlefield. That means energy infrastructure is now on the table. It's fair game for a target in this geopolitical CF that's going on around the world. So it's conceivable, even probable, that there are more targeted attacks on civilian energy infrastructure in the near future caused by this attack on the pipeline. And one of the places I've been warning about since last year is the Strait of Hormuz, because a large chunk of the world's oil and liquefied natural gas flows through the Strait of Hormuz. And why do I mention that? Well, consider this article that came out last Thursday. U.S. imposes new sanctions on Iran oil exports and targets Chinese firms. The United States on Thursday imposed sanctions on companies it accused of involvement in Iran's petrochemical and petroleum trade, including 5 based in China, pressuring Tehran as it seeks to revive the 2015 nuclear deal. So remember, the Iranian regime is becoming increasingly desperate as the economy in that country is in shambles. Now they've got widespread protests caused by the death of Mahsa Amini in police custody. There's been protests and riots all over Iran since that happened. And I've talked on this channel a lot how desperate tyrannical regimes will often resort to starting a war with an outside power as a way of deflecting public anger outward. Don't put it past the Iranians to start something up in the Strait of Hormuz to try to save face with their own people. And not to be outdone, it seems Europe has chimed in and they're contributing to the situation as well. Germany and others in the EU plan Iran sanctions over protests and clampdown. Germany, France, Denmark, Spain, Italy, and the Czech Republic have submitted 16 proposals for new European Union sanctions against Iran for its violent crackdown on protests over women's rights, a German Foreign Ministry source said on Monday. The proposed measures would target people and institutions primarily responsible for the clampdown on nationwide protests that were ignited by the death in police custody of a young woman, the sources added. So since that pipeline attack, targeting energy infrastructure is fair game in geopolitics, and now we've got an increasingly desperate Iran that's being hit with additional sanctions. Well, one of the things that Iran has been threatening to do for years is to shut down the Strait of Hormuz, and they've been developing the technologies to do it. A combination of speedboat attacks, drones, mines, and anti-ship missiles could all combine to make a real mess in the Strait of Hormuz, enough to disrupt shipping there. And you better believe the Russians are on the phone right now trying to convince the Iranians to do exactly that, to put even more pressure on the West in the energy sphere. Now, if something like that were to happen, forget $100 a barrel. We're talking $200, maybe even $300 a barrel if that ever happens. Don't put it past them, folks. Our leaders are not done making this world worse. Now, I'd be remiss if I didn't mention the one thing that could possibly send oil prices lower, and that is a large reduction in demand caused by a global recession, which looks increasingly likely. If we're on the brink of a major financial crisis and banks fail and companies go under, then there's going to be a lot less oil consumed, and that could be enough to send prices lower. Now, to see what that might look like, I decided to go back in time and look at the charts from the global financial crisis to see what happened then. Now, this is a chart of daily oil demand going all the way back to 2006, and it's also projected out to 2026. Now, I'm going to ignore for a second what happened in 2020 because of the COVID lockdowns. That caused an astronomical reduction in oil demand. I don't think that's a good comparison because everybody was literally locked in their house and businesses were forced to shut down. Even a global recession or depression wouldn't cause that much of a decrease in demand. So I'm not going to look at that one right now. I'm going to look instead at the global financial crisis from 2006 through 2009. Now you can see here the peak in oil consumption in 2007 hit 86.3 million barrels per day. And then in 2009, at the height of the GFC, oil demand reached as low as 84.3 million barrels per day. So the GFC saw a net decrease of 2 million barrels per day in oil demand, and that is a global number. So if the GFC were to happen over the next couple of weeks, it's reasonable to say we'd see something like 2 million, maybe 2.5 million barrels per day of oil demand loss or demand destruction caused by that economic slowdown. But remember, between the SPR releases ending, the OPEC production cuts, and fuel switching caused by the high natural gas prices, we're already looking at 2.6 million barrels per day in additional tightness in the oil markets, which would more than offset even another GFC happening right now. So even in a worst case scenario for our economy, we're still looking at a tighter oil market than we have at this moment, which means prices would still want to move higher. So long story short, there are a whole lot of forces lining up to put more upward pressure on oil prices, and really the only thing threatening to take oil lower is the prospect of widespread global recession, which even if that were to happen, it may not be enough to offset those bullish cases for oil prices. And all that gets set in motion this Wednesday when OPEC gets together in Austria, and they're expected to announce a production cut of about 1 million barrels per day. Now, at the beginning of this video, I promised you one more thing that could be even bigger than a big production cut. And since you stuck around this far, here it is. And that would be a reshuffling of OPEC's quota. See, right now, every country is given an allowance of how much oil they're allowed to produce every month. Now, some countries are making that quota or just barely missing it, and some countries are missing it by a huge margin. Now, when they raise or lower their production targets, that is distributed evenly across all the countries, regardless of whether or not they're making their quota. So when they announce a production cut of, say, 1 million barrels on Wednesday, the countries that are already missing their quota by a huge margin won't be affected. The only actual cut to production will be the countries that are very close to their quota. They'll see a loss of some oil production there. So even if they were to announce 1 million barrels per day of production cut, maybe it only results in about 400,000 or 500,000 barrels per day of actual lost production. But if they reshuffle the quotas based on what the production currently is to go along with that production cut, then 1 million barrels per day of a reduction in the quota would translate to an actual 1 million barrels per day of less production. So if the market sees not just the production cut, but the reshuffling of the quotas, then expect a very strong upward movement in oil prices on Wednesday in reaction to that. That's one thing that could really amplify this move in oil prices in the short term. But remember, the prospects for a global recession will continue to be a headwind for oil prices, so we have to keep an eye on the possibility of a widespread financial crisis. And if you want to know a little bit more about that, you can check out this video I made about how this financial crisis will be like no other one we've ever seen before. Till next time, live small and dream big.